I need you to imagine something with me. It's 7:42 on a Tuesday morning. The coffee is still hot, the house is quiet, and a 67-year-old retired high school principal named Walter is staring at a letter from his bank with his hands shaking. Not the IRS, not the police. His bank. The same local bank he had trusted for 19 years. The same bank where tellers asked about his grandkids. The same bank where he deposited 31 years of hard-earned savings after retiring. The letter said his account had been reported to federal financial authorities for review. Reported. Walter had never missed a tax payment, never bounced a check, never even carried credit card debt into retirement. He spent 3 decades managing school budgets down to the dollar, and now, after doing everything right, he felt like he'd done something wrong. When he called me, his voice wasn't angry, it was frightened. He said, "I worked 31 years for this money. I did everything the responsible way. How is it possible that doing everything right got me flagged? If you are over 60, I want you to stay with me today." Because what happened to Walter is not rare. It's not political. It's not a conspiracy. It's something far simpler and far more common. It's a rules problem. And most seniors were never told the rules. In this video, I'm going to walk you through 5 real federal banking and reporting rules that affect seniors right now. These are documented laws under the Bank Secrecy Act, IRS regulations, FDIC insurance statutes, Medicare income rules, and Treasury reporting systems. They have been on the books for decades. They are actively enforced, and they apply whether you know about them or not. This is not about hiding money. This is not about avoiding taxes. This is about understanding how the system works so you can protect your dignity, your independence, and the savings you built over a lifetime. And if you stay until the end, I'm going to share the #1 overlooked strategy that has saved some seniors thousands per year in Medicare and prescription costs. A strategy that most people qualify for and never apply for. But first, you need the foundation. Here's the truth most retirees don't realize. The banking world you entered in the 1970s, 80s, and 90s does not operate the same way today. Federal monitoring systems are automated. Reporting thresholds haven't been adjusted for inflation since the 1970s. Digital pattern tracking is normal, and seniors, especially those consolidating accounts, receiving inheritances, taking retirement distributions, or paying for medical care, often trigger review systems without ever intending to. Walter's situation began with something very simple. He had received a large distribution from his retirement account. Instead of moving it all at once, he transferred portions over several weeks into his checking account. Each transfer felt responsible, controlled, careful. But to automated federal reporting systems, that pattern looked like something else. Let me explain how this works. Under the Bank Secrecy Act of 1970, banks are required to file a currency transaction report, a CTR, whenever a customer deposits or withdraws more than $10,000 in cash in a single day. Physical cash, not checks, not electronic transfers, physical currency. That $10,000 threshold was set more than 50 years ago. Adjusted for inflation, that would be well over $75,000 today, but the law hasn't changed. Here's what most people don't understand. A CTR is not an accusation. It is an automatic filing. Millions are filed every year. If you deposit $12,000 in cash from selling a vehicle, the bank files it. End of story. No drama. The problem begins when people try to avoid that threshold. There is a separate federal law, 31 U.S.C. Section 5324, commonly called the structuring law. It makes it illegal to break up transactions specifically to avoid the $10,000 reporting requirement. And here's the part that shocks most seniors. The government does not have to prove that your money was illegal. They do not have to prove tax evasion. They only have to show a pattern that appears designed to stay under the reporting threshold. Walter didn't even know this law existed. He simply thought spreading transfers out felt safer. But the automated pattern recognition systems used by banks and FinCEN, the Financial Crimes Enforcement Network, are specifically programmed to detect repeated sub-$10,000 movements. When compliance officers see patterns that resemble structuring, they can file what is called a Suspicious Activity Report, or SAR, and federal law prohibits them from telling you they filed it. You cannot demand to see it. They cannot disclose it. That was the letter Walter received. His account activity had triggered internal review. Now here's where I need you to take a breath. In the overwhelming majority of cases, These reports do not lead to charges. They do not lead to seizures. They are data points in a massive system. But the fear, the confusion, the humiliation of feeling flagged after decades of honest work, that's real, and it is avoidable with knowledge. The correct action, if you ever need to move more than $10,000 in cash, is to simply do it in one transaction and let the bank file the routine CTR. Do not artificially break it up. Natural financial behavior is safe. Artificial adjustment to avoid a threshold creates risk. That's rule 1 and 2 combined. And most seniors were never told either. Now let's go deeper, because reporting rules are only part of the picture. The third issue I see constantly is FDIC insurance misunderstanding. FDIC insurance covers up to $250,000 per depositor, per bank, per ownership category. That means if you have $300,000 in a single checking account in your name at one bank, $50,000 of it is uninsured. In 2008, seniors learned this the hard way. And again, during regional bank failures in 2023, many retirees suddenly realized they were exposed above coverage limits. Dorothy, age 72, came to me after selling her home. She had $418,000 sitting in one savings account at a regional bank because that's where I've always banked. She assumed the government insured it all. It did not. We restructured her accounts across 2 institutions and adjusted ownership categories so that every dollar fell under FDIC coverage limits. She slept differently after that. Her words, not mine. That was the first time since my husband passed that I felt secure again. That's what this is about. Not fear, security. Now let's talk about something quieter, but financially powerful. Interest income. Every bank must issue a 1099-INT form if you earn $10 or more in interest during the year. That form goes to you and the IRS. It is taxable ordinary income. In a 4% interest environment, a senior with $250,000 in savings earns $10,000 in interest annually. That $10,000 gets added to your adjusted gross income. And here is where it connects directly to Medicare. Medicare Part B and Part D premiums are subject to IRMAA, Income-Related Monthly Adjustment Amount. If your modified adjusted gross income crosses certain thresholds, for 2026, for example, roughly above $103,000 for individuals and $206,000 for married couples. Though you must always check the latest numbers at ssa.gov, your Medicare premiums increase. Some seniors accidentally push themselves over an IRMAA threshold because of interest income, retirement distributions, or capital gains. And they don't realize until 2 years later when higher premiums appear. James, age 70, earned strong interest income after moving funds into a high-yield account. It added nearly $9,000 to his reported income. Combined with a small IRA distribution, it tipped him into a higher IRMAA bracket. His Part B premium jumped significantly. He thought it was a mistake. It wasn't. But here's the hopeful part. IRMAA determinations can be appealed if you experience a qualifying life-changing event like retirement, death of a spouse, divorce, or work reduction. Using Form SSA-44, you can request reconsideration based on lower current income. James filed that form after fully retiring the following year. His premiums were adjusted downward. Knowledge changed the outcome. And this brings me to something even more powerful. If you are finding this helpful so far, take a second right now to like this video and subscribe. This channel exists to give seniors evidence-based official rule information without scare tactics. And stay with me, because the #1 overlooked benefit at the end could reduce your Medicare and prescription costs dramatically. Now let's talk about the hidden system most retirees miss entirely. Suspicious activity reports are one side of federal oversight. But on the benefit side, there is an equally powerful system designed to help low and moderate income seniors, and millions never apply. I am talking about the Medicare savings programs and Extra Help. These are real, federally authorized programs administered through your state Medicaid office and the Social Security Administration. Medicare savings programs can pay your Part B premium. In some cases, they also cover deductibles and coinsurance. Eligibility is based on income and limited resources, but the thresholds are higher than many people assume. Extra Help, also called the Part D Low Income Subsidy, reduces prescription drug premiums, deductibles, and copays. In 2026, many qualifying seniors pay little to nothing for Part D premiums and dramatically reduced copays for medications. And here's the synergy most people miss. If you qualify for a Medicare savings program, you are usually automatically eligible for Extra Help. That means coordinated relief, lower Part B costs, lower drug costs, reduced out-of-pocket exposure. Maria, age 74, was living on Social Security and a small pension totaling about $1,850 per month. She assumed she made too much for assistance. After reviewing her numbers, we realized she qualified for a Medicare savings program in her state. Her Part B premium was covered. She was automatically enrolled in Extra Help. Her prescription costs dropped from over $200 per month to under $40. She cried on the phone, not because of the money alone, but because she felt seen, supported, not forgotten. This is why I tell you, you are not behind. You are not foolish for not knowing. These systems are complex by design. And now we arrive at the number one secret most seniors miss: the right to appeal. Almost every Medicare premium determination, IRMAA surcharge, Part D penalty, coverage denial, or benefit rejection has an appeals process. Late enrollment penalty for Part B, appealable under certain conditions, denied Extra Help, appealable with documentation. IRMAA surcharge, appealable using SSA 44 for qualifying life events. Medicare Advantage coverage denial. Multi-level appeal rights exist, starting with plan reconsideration and escalating to independent review entities. Yet most seniors assume a letter is final. It is often not. Evelyn, 68, was assessed a late enrollment penalty for Part B because she delayed enrollment while covered under what she believed was creditable employer insurance. The penalty would have followed her for life. She gathered employer documentation, filed an appeal, demonstrated creditable coverage, and the penalty was removed. That decision saved her thousands over retirement. Appeals are not confrontations, they are rights. And rights restore dignity. So let's bring this together. Understand cash reporting thresholds and never artificially structure transactions. Keep deposits within FDIC coverage limits. Monitor interest income and its Medicare impact. Know that banks can file reports without telling you, so maintain documentation. And most importantly, stack your benefits intelligently. Medicare plus Medicare savings programs plus Extra Help plus Medicaid if eligible plus SNAP plus property tax relief programs at the state level. These programs are designed to work together. When coordinated properly, they can protect thousands per year. Now, I want to hear from you. How old are you? And what is your biggest financial stress right now? Medical bills, prescription costs, rent or property taxes, food, retirement timing, caregiving for a spouse, or fear of scams and account freezes? Write it in the comments, not just for me, but so others can see they are not alone. Because here is the truth no one tells you loudly enough. Aging is not a financial failure. Needing clarity is not weakness. Asking questions is not ignorance. You built this country. You paid into these systems. You earned the right to understand how they work and how they can work for you. Walter reorganized his accounts within 30 days. He documented major transfers. He spread deposits within FDIC limits. He consulted his CPA about interest projections. 6 months later, he called me again. His voice sounded different. "I feel back in control," he said. "That is what I want for you. Control, confidence, calm. You are not behind, you are not alone, and as long as you are breathing, you have options." I will see you in the next video, and we'll keep building your protection one rule at a time.